Folks, welcome to Monday Education. Hope everybody got plenty of rest after the Super Bowl last night. Good morning, Erla. Good to see you. Usually a small crowd the day after the Super Bowl. Weird, I don't know why. Welcome to the room, everybody. Excited for a brand new week of study. We're going to have some fun today. Today is Monday, February 10th. Hey, good morning, Miss Adriana. And we have just tentative news, and it is low impact. So nothing really noteworthy in news today. But I do come to forexfactory.com/calendar every morning. I make sure that there's not high or medium impact news releases because stuff like that can really make the market just go a little nutty. And when you talk about a little nutty, it just means that it could become untradeable. It could be too fast. It could be too erratic. So everything that I do in my own personal trading revolves around advantages. And I feel that trading into red or orange, high or medium impact news removes my advantage, and I choose not to do it. So every morning, that's a part of my routine, just coming in and checking. Everything that I talk about comes right from the Nexgen page, specifically the trading guide. All the answers. And I know that sounds like, oh, he's just saying it's all the answers. Guys, it's all the answers. Everything that you need. The entire trading plan is right there. Stuff on market flow, the next trades that you're going to learn. There's so much information available to you, not only on the website. There's so much information available to you from the Nexgen YouTube site. I mean, there is an overwhelming amount of good stuff to make you a little smarter than you were yesterday. We're going to keep it very focused, though. What we're going to do for the first hour today, and really for the first hour every day, to be honest with you. Uh-oh. Give me just 1 second. My PowerPoint is on the wrong screen. I'm not sure how that happened. Give me just 1 second, guys. Sorry, a little technical difficulty here. Let me change that to the right monitor. There we go. Now we got it. Guys, we're going to talk about the high probability trend trade this morning. We're going to focus on this one trade. And we're going to do it because it's going to teach you to read your charts. That's the whole goal. Why is it not working? I'm struggling here, guys, not gonna lie. There we go, hold on. We're gonna try this one more time. It's Monday, right? I didn't even drink last night. Must have been the wings. All right, good morning. We're gonna try this again. Good morning, Mark. Good. I got you changed in your role so that you could post. All right. Sorry, I missed all those. Good morning, Steve. Good morning, Bob. Good morning, Jeffrey. Good morning, Luciano. Sorry, guys. A little technical difficulty this morning, but we have it now. Now we're gonna full speed ahead. Full speed ahead, guys. We're gonna focus on a high probability trend trade. So I'm looking in and I see some newer names. Welcome to the room. Welcome. Guys, this education room is designed to be a discussion rather than a lecture. This education room is designed to take all the information that's available regarding what you can do with the software and really focus it, streamline it into the most basic remedial 101 approach to being successful with the software. So we do that by talking about a high probability trend trade each and every morning. And a high probability trade is defined as when each indicator on every chart agrees for the rules. So we're doing this because the whole goal in the beginning is to learn how to read your indicators, to be able to look at your charts and simply say to yourself, hey, I have what I need to take a trade. So as we focus on this and you begin to see these advantages, you're going to realize that about 90% of your day will be spent reading indicators. 90% of your day is doing nothing. And I know that sounds boring and not very exciting, but remember that trading isn't your adrenaline fix, guys. Trading isn't your your excitement for the day. Trading is a job. Trading is getting into the market, getting out of the market, and trying to win more than you lose so that you can create a life for yourself that you've always dreamed of. So we're going to do that with the high probability trend trade. And once you keep it basic and focus on this chart read, you will understand where the market is likely to continue. Initially, this is your entry for the highest probability trend trade. It'll also be your entry for the trades that you see after you recognize this trade. You're going to understand where the market is likely to go. This is going to help you make intelligent choices regarding your profits. And you're going to understand where the market is likely to stop. These three concepts are just a result of learning to read your charts, learning to take that information. And we're going to do it. You guys are going to be able to learn to be amazing chart readers with only 3 rules. These are the rules for the high probability trend trade. I would appreciate it if you try not to overthink it. I think you will find a higher level of success if you try to not break outside of this as a brand new user. Give it a couple weeks to learn these concepts, because each rule, when true, gives an advantage. So the rules are in white, the advantages are in yellow. Your goal, brand new users, is to be able to identify momentum through strong trigger lines, rule number 1, and to be able to identify a clear path, meaning that there's nothing in your way, no area is likely to stop the market, through rule number 2. Once you understand these two, once you can identify these two, you really have everything that you need to create a very consistent, very profitable trading plan. And this is going to be the core of pretty much everything that you do with the software. Being able to recognize where highs and lows may occur, and then using the idea of momentum to understand whether or not they may. Your first 2 rules lead you to the 3rd rule. And the 3rd rule is specific to the high probability trend trade. The 3rd rule is just an entry area. It's pinpointing where that market is most likely to continue so that you can take those first 2 advantages and try to capitalize. These 3 rules that we're going to break down individually, I'm going to teach you how to study them. They happen on only 2 charts. There is a large chart first. Large chart leads the way. Large chart is the reason that you'll ever go look for an entry, because your large chart is going to define the direction, the momentum, and the areas that are important to you. It's a very broad stroke of a brush. It is a slow-moving chart. It's difficult to see change. And you can get all of this great information on the first bar, the most current printing bar. You'll understand whether or not you have the advantage of momentum through rule number 1. This happens on a large chart. You'll understand whether or not you have a clear path. Rule number 2. This happens on the large chart. So you could spend a whole week doing nothing but becoming a master of the large chart, and it's going to set you up for success. And once these 2 rules are met, you'll turn your attention to a smaller, faster chart. And this is a refinement chart. What happens in that 1 bar on the large chart from top to bottom is 20 to 30 bars on the smaller, faster chart. It's literally giving us an x-ray of what's happening on that large chart. So you can see I put a black square around 1 bar on the large chart. Inside of that black bar, or that black box on a small chart, is an entire retracement, a bounce off of an area, and continuation with the trend. This is the refinement process that's going to allow you to pinpoint where the market is most likely to continue. By using this refinement chart, you'll be able to reduce risk dramatically. You'll even be able to increase your profit potential waiting for these pullbacks. So rule number 3 is just designed to get you into the market. It is specific to trend trades, but rule number 3 should never even get on your radar until the large chart says look for an entry when the first 2 advantages are present. We use these 2 charts because they're a reflection of who you're trading with or who you're trading against. The large chart, I want you to think of them as the large crowd, the men and women with the money and the influence to create trends. The men and women that create the momentum that gives us that first advantage. And these are the same men and women that are reacting right at the key areas on your large chart that tell you, hey, no more trades into this area. Buyers are buying and sellers are selling and fights are happening. So the large chart leads the way. The large crowd leads the way. Good morning, Sid. The small chart is like the small crowd, and they still have way more money and influence than you do. And they create these little ripples in the matrix, what we call a retracement or a pullback. When the large crowd wants everything to go up, the small crowd typically fights. They create a little shove. Well, your small crowd loses 70 to 80% of the time. Rule number 3 is designed to put you in the market right where their failure is most imminent. And if they're losing 70 to 80%, it means that you're putting yourself in the position to have the potential to win up to 70 to 80% of the time by using that refinement chart to get into the market where the market is most likely to continue. So that's kind of what we're going to do. We're going to talk about this rule, break them down individually. We're going to spend the next hour learning the trigger line and the Fibonacci rules for when it's okay to trade. Just commit from day one. I'm going to trade when my rules are met. I'm going to sit on my hands when they're not. We are professional waiters, but we're going to learn these rules. I will break them down individually. Good morning, Gary 41623. I see you typing and backing out. We're going to learn the rules for when it's okay to trade. We're going to break them down individually. You'll be able to know exactly what they look like, what they mean to you, and I'm even going to give you tools to study them. With your demo, with your lease, with your ownership, you can simulate. You can practice these rules with absolutely no risk to you, no financial hardships if you don't do well. But the first step in becoming a confident trader, ASAP, no sound. Guys, give me a Y if you can hear me, please. All right. We're going to see if we can get this one fixed out. Gary is new, excited to have him. Let me see. So, headphones. Be able to hear. If you can't, try to kill Discord and re-enter the room. Give me just 1 second. All right. So guys, if you ever can't hear me, always post in the room. And if you see a whole bunch of Y's come into the room after, it means that it's probably on your end. Rebooting the room is almost always the quickest way. So We'll see if Gary gets back in. Hopefully he does. And we'll get some good stuff, guys. So the first step in getting to where you want to be, post in the room. And I see some new names in here. And I'm going to tell you, it's terrifying to post in this room. Because what if you're wrong, right? Oh my gosh, I was going to post a picture of a trade I took, but I lost. And I don't want a whole bunch of brand new people to trading to think I'm not an expert when I'm brand new. And that's normal, it's ego. Guys, the more you post in the room, the more you're going to get out of this room. So every time you take a trade, every time you see something on your charts that you don't understand, if you watch one of Nexgen's educational videos and something doesn't make sense, take a picture of that part of the video and bring it to the room. Every time you post in my room, it's going to be a conversation. We're going to have a one-on-one, a private session to get you exactly where you need to be, to make sure that your chart read is accurate, to make sure that your entries made sense, that your exits make sense. So the people that post the most typically get to where they want to be the fastest. That's the first step. We're also going to simplify this morning. I'm going to give you a written trade plan. It is going to have 2 trades on it. The first trade will be the highest probability trend trade you can take, everything that we talk about in the first hour. The second trade will be one that requires the skill set that you build from that trade. All right, Gary, I see you back in. Can you hear me? Fingers crossed. Fingers crossed. We'll see if Gary can hear us. I'm rooting for him. Nothing worse than sound issues when you're day one, right? What a horrible start. As we're going to simplify a lot. And what we're going to do is we're going to talk about the patterns that have been proven to win more than they lose, the patterns that we're studying, the advantages that come into play. And you've got to learn these looks, and you've got to learn the looks so that they become easy. And that is repetition. Repetition is the only thing that creates that awareness. Repetition is the only thing that creates that easy feeling, looking for something going on in the market. So that's the second piece of the puzzle, is finding or using the spreadsheet that Nexgen gives you when you download the software. I'll give you mine right now. I'm going to drop it in the room, and there's a little update in there in management stuff. I did some work yesterday morning. Use the spreadsheet. The spreadsheet is nothing more than an Excel spreadsheet. Gary's out again. Gary, can you hear me? And this Excel spreadsheet has 4 tabs on it. The first tab is trade tracking. This is where every time you take a trade on simulator, you're going to post a picture of it. So there's a couple things in the picture section here. How to annotate for the best feedback. This is important. If we're going to have a private session, if we're going to talk about your chart read, I need to know what you're reading. Strong triggers, clear path, entries and exits. So I want you to cover all of those. I want you to pretend like I don't know how to read a chart, and tell me what you see. Tell me what your chart read is. And what we'll do is, if you need a little help on any one of these concepts, we'll come up with it. We'll create a plan to make sure that you're reading accurately, that your entries have the least amount of risk, that your exits make sense. This is the first section. There's also, in that section, feedback from class. So each picture posted is going to get feedback. I go through them in the second half of class, click on them in order, and every time you post in the room, we're going to talk about everything that you did. And a couple things happen with this. One, you get the feedback. So if every morning you come back to that spreadsheet and you look at what you did yesterday and you say to yourself, all right, what worked? I want to do that again today. Or what didn't work? I want to avoid that today because I prefer to win over losing. I prefer to have those advantages rather than trading without them. You'll see patterns that are bringing you success, and you'll also see patterns that are taking that success away from you. And if you do this brief historical study each morning, guys, it really will accelerate the learning, Because every time you get feedback, I'm going to give you something to focus on. You're going to understand whether you identified your advantages correctly, whether your entry made sense, was the least amount of risk, and whether or not your targets were logical or based in hope. The second page is the first two advantages of the high probability trend trade. I even took out this weekend I hid the section, it's still in there, the entry section. Because I want you guys to focus on strong triggers and clear path, because these are the two that pay dividends. So there's a section that shows you exactly what it looks like to have strong triggers. Each of these pictures was taken, is annotated, it describes the look and what it means to you, and then you also see what it means to not have that advantage. So one is rules met, one is rules not met. And then in order to get off that large chart, we're looking for both green sections, both strong triggers and a clear path. The third tab is the client trades. And this is the high probability trend trade, both long and short. It's the sequence for entry so that you can go through the process. The green section is Nexgen users just posting in the room, and I steal their pictures, and I have absolutely no shame about it. Every time you guys do something amazing, follow those advantages, those rules, I like to steal it, and I like to drop it in here. And there's almost 400 pictures of you guys doing great things with this software. There's a lot of you that are adrenaline junkies. You want to trade the NASDAQ. I've started to put in some NASDAQ stuff here. I will tell you the NASDAQ is about 10 times faster than crude oil or the S&P. And if you're not comfortable with your chart reads, the NASDAQ typically just runs you over and leaves you really sad in the middle of the floor. There's a management section. The first section is a very mechanical management beginner plan. This is going to be what it looks like on that written plan that I give you. But one of the great things is the more you look at your indicators, the more you learn to read your indicators, the more in tune with what they're telling you that you become, the more you're going to see. And that means that your management plan may change a little bit. It means you may hold for bigger moves, or you may find reasons to exit. Take those pictures on your management plan. Take the feedback from the pictures you post in the room. Create your own management plan. And then once you get good at reading indicators, you're going to begin to see patterns. You're going to see the same thing happening over and over. Some of these will help you with management. Some of these will keep you out of trades. Some will get you into trades that you weren't previously taking. But there's a lot of great lessons there. And then finally, the last tab is where you're just going to build your trading plan. So when the rules are true, take a picture. Start to commit that look to memory. As you work on management, as you see patterns, the more pictures you take, the quicker you're going to get to where you want to be. And I want to show you just math. I love math. 15 pictures a day. Whoops, let's do it where it's black. 15 pictures a day. That's it. I want you to commit to 15 pictures a day. Because 15 pictures a day is 300 pictures a month. And 300 pictures a month has you just under 1,000 pictures after 90 days of study. And that's a pretty low number. If you look at my picture count for 2025, I'm just under 900 already. And we are all of 40 days into it. So I'm averaging a little over 20 pictures a day, and I know how to read charts. It would make sense that you would be taking pictures. Try to pace me on this one. That's what's going to get you to where you want to be. That's what's going to create that recognition. I don't like math. I'm no good at math. So we're going to go through all this stuff. We're going to give you guys the rules. I'm going to hand you the rules. I'm going to teach you what they look like. I'm going to teach you how to study them. I'm going to give you everything that you need to be successful with this software. The only thing I can't do is make you do the work. I can't make you take the pictures. I can't make you post in the room. But I'm telling you right now, if you post in the room, if you use that spreadsheet, you will get to where you want to be quicker. If you're coming back to my room and it's been a while and you're like, man, I'm just not hitting the numbers that I want to hit, go back to basics. You'll be surprised at how quickly you get to where you want to be. So we're going to get going, and we're just going to figure out what it is we're looking at. So if you're brand new with me, this is nothing to do with trades. This is only indicator identification. Every chart that you look at, large and small, will have small and large triggers. Your small triggers are a fast moving average. They are solid lines, and those solid lines work together to create the small triggers. Your large triggers are dashed. They're a slower moving average. And it takes two of the lines to create the large triggers. So small triggers and large triggers. You're going to use trigger lines first to establish momentum. You're going to use trigger lines to determine whether or not you have reached an area that could potentially be problematic. You're going to use trigger lines for entry. So know the difference between small and large. Also, on every chart, you're going to have areas. And the areas have names. You are going to see divergence highs and divergence lows. A divergence high is a magenta or pink line that prints off of a pivot if there's a loss of momentum. The divergence low is a cyan line that prints off of a pivot if there is a loss of momentum. So every time you see divergence, I want you to think to yourself, there's a loss of momentum. Momentum isn't following price, and this is going to come in as you grow with the software. So divergence highs and lows, know what they look like. Fibonacci resistance is that horizontal red line that runs the distance of the chart. Fibonacci support is the blue line. You're going to see yellow 1-to-1s, and you're also going to see mid-bands. So these are the working pieces of the software. There are triggers and there are areas. And what we're going to do is recognize a pattern that is repeatable, that's verifiable, that has been proven to win more than it loses to create this highest probability trend trade. Sorry. So we're going to start at rule number 1. Large chart, 13-2, big chart, needs strong trigger lines. Remember that the large chart is going to lead the way. The large chart is going to define the direction as well as the momentum. So we're going to let it define direction, and that's going to lead us into momentum. If the background on your large chart is green, well then we're in an uptrend. And I'm only looking for rules to be met for high probability trend trades long. The trend is your friend. You've probably heard this before. If the background is red, it's a downtrend. We're looking for rules to be met for high probability trend trade short. So the first thing I'm going to do is just look at that background color and decide which direction I want to be trading. In order to have strong triggers in an uptrend, the small triggers and the large triggers have to be green as well. So the colors need to match between trigger lines and the background between the trigger lines with one another. So strong triggers up, everything will be green. Strong triggers down, everything will be red. Strong triggers means in an uptrend, the small triggers are up and above the large triggers. There's space created between small and large. And in a downtrend, the smalls are below. And there's space created between the small and the large. It's that space that looks like scissors that have just opened up. That space lets me know that the odds are favorable for the market to continue in the direction of the trend. And that odds favorable momentum is kind of going to be our battle cry here in this room. Odds favorable momentum, and you get that big push down, and odds favorable momentum, and you get that big push up. And momentum is difficult to stop, and momentum can break key areas. And momentum will even cover some of the mistakes that we tend to make as new users. And momentum is pretty easy to identify, and momentum is the exact same no matter what chart or what market you're looking at. Crude oil, this will always be strong triggers to the upside. This will always be strong triggers to the downside, but you've got to know the difference between strength and weakness. Because weakness is the giant red flag telling you, hey, don't take that trade. The market's not likely to continue in the direction of the trend. And actually, when the small triggers work their way inside of the large trigger, this weakness, you're going to see ACH. Anything can happen. This is where retracements tend to happen from the middle of nowhere. This is where Fibonacci areas are more likely to reverse the market. So understanding the difference between strength and weakness is designed to keep you out of a lot of trouble. And you'll notice that weak triggers right at a fib, big untradeable bounce. Weak triggers, again, that's where the retracement came from. Strength pushes up, the triggers weaken, and that's where the market starts down. So I'm going to ask, is everybody good? Let it be simple in the beginning. You either have strong triggers or you have weak triggers, and only one of them is when the rules are met. So when I have strength from separation to where it closes, when I have strength, anytime on one of those large bars, that one bar that defines it, if price drops below the middle point of the bar, you'll see these tails or these wicks. Each and every one of these wicks and tails are a potential entry on that smaller, faster chart. So I can use these to go back and study this pattern a little bit. In a downtrend, it's the exact same thing. You'll begin to see these tails printing, and it's difficult on that large slow chart to know where that tail is most likely to form, where it's most likely to top out. Rule number 3 will have you pinpointing that location and allowing you to enter the market with the trend, with the momentum, with the clear path. And you'll use that as a study tool as you come through. And if you go back and look at, there's one of those tails there with all that momentum, and you see it again over here. These are probably lessons from last week. We'll go back and look at them again. So give me a Y in the room, please, if you're with me. Strong triggers on the large chart. This is a big chart endeavor. This leads the way. Pushes the market, can break key areas, can cover mistakes. This is when we're looking for the best of the best. Once I have momentum, once momentum is in play, once those indicators tell me that the market is likely to continue in the direction of the trend, I'm going to make sure that termination conditions are false, that there's nothing in my way to create a big ugly bounce. This is going to give me room to my profit targets, and we're just going to call it a clear path. Remember, momentum and clear path. This is your core. What's a termination condition? It's a horizontal line on the big chart. That's the easiest way to say it. Termination conditions come from your larger, slower chart. They're a Fibonacci-based indicator that may reverse the market based on a comparison of that Fibonacci area, excuse me, and the T3 trigger strength and location. It's a horizontal line on your large chart where the large crowd is going to make decisions. Every time price reaches a divergence high or a divergence low, every time price reaches Fibonacci support or resistance, yellow 1-to-1, the large crowd, the people in control, are likely to make a decision. This is where people enter, where they exit, where fights happen. This is where reversals can happen. So we're going to take that idea that the large crowd is making decisions at key areas, and that's how you'll define a termination condition. You will allow price to reach the area to set off that decision-making process. If price hasn't reached the area yet, that area is going to be a target for me if I find a rules-based entry. But once those dynamic wrinkle bars reach Fibonacci resistance, that also qualifies as a divergence high. It could be yellow 1-to-1s. But when price reaches an area of resistance, all you have to do is ask yourself, where are my triggers? If your triggers remain below that area of resistance, it's a termination condition. It means that there could be an untradeable bounce that could pull you out of a long position. It means that there could be a fight between buyers and sellers that keeps you from having your rules met. It could break. Areas break all the time, especially with momentum, or that termination condition may reverse the market. The one thing that you'll never be sure of is what that reaction is going to be. So When rule number 2 is not met, absolutely no trades into the area. Give it a minute. Wait for the reaction. If it reverses the market, now it's what we call a strong top. And a strong top means that when the buyers reached Fibonacci resistance, the decision made by the sellers was so impactful that they reversed the market and sent it screaming the other direction. You'll see those large triggers roll from green to red. A strong top is not mandatory for the high probability trend trade, but it adds a boatload of warm fuzzies because it sets you up for the highest probability trend trade you could ever take. And if the market is screaming down, whether you find an entry or not, once those price bars reach Fibonacci support, all you have to do is ask yourself, where are my triggers? And if my triggers are above Fibonacci support, it's a termination condition. Rule number 2 is not met. They could fight, it could bounce, it could break, it could reverse. I'll never know what it's going to be. So absolutely no trades into the area. Rule number 2 is designed to keep you out of an awful lot of trouble. And just for grins, from support to yellow 1-to-1s and resistance, back to support to resistance to support, resistance breaks, behaves as support, and now we're up into a divergence high. Rule number 2, resistance, 1-to-1s, resistance, support, resistance. Guys, the easy money is between areas, not into areas that could create a fight. And all you have to do is study this a little bit, and you will be on board with the idea that absolutely no trade should be taken into these areas. But they do break. If they didn't break, the market would be caught in a range. So this is what it looks like when an area breaks. This also describes the 3 potentials, or the 3 things that can happen as an area breaks. So number 1, price reaches resistance. All the triggers are still below. This is a termination condition. Rule number 2 is not met. I don't have a clear path. My highest chance of success as a day trader will come from doing absolutely nothing. Sounds easy, right? All I have to do is nothing. That's going to be the hardest thing you ever do. And that's okay. No trades. Every line is going to be a termination, at least for a second. If this area has the potential to break, the trigger lines will tell the story. Once price reaches the area, we're done with price. We're going to let the trigger lines tell us what's going on. And if your small triggers smash through the area, I'm talking 2 to 3 points above, both lines, but the large triggers are lagging. They haven't made it above. As long as there is odds favorable momentum, as long as there are strong triggers, you can say this area has the potential to break. You can take a trend trade with that potential, but because it's not broken yet, you will need to manage a little more assertively. This is what we call a 50-50 trade. 50% of my triggers are through, 50% are not, and with all that momentum and the potential to break, I can take opportunities, but I have to manage aggressively. This will be the second trade that's on that plan. The easiest trades come from when both the small and the large triggers break above resistance. Both lines, it takes 2 lines to create a large or a small trigger. Once both sets of triggers are north of resistance, resistance behaves as support. Your path is now clear. Your path remains clear until you reach the next area. So with this look, I'm looking for entries all day long until I reach the next line. Going short's the same thing. Price reaches support, triggers remain above. I'm just going to wait for the reaction. My best chance of success comes from doing nothing. 50% of my triggers smash through the area, 50% lag behind. As long as there is separation between small and large and I have that strong trigger look, this area has the potential to break, but it's not broken. Anything that I do with this look must be managed assertively. But once the small and large get below support, support behaves as resistance. My path is clear all the way up until I reach the next area. So let's go back to that large chart, guys. Let me know if that makes sense. Price reaches a divergence high. The triggers don't break, and guys, that's precisely where that reversal starts. Both small and large get below support, But with that weakness, there's still a big retracement. Without the advantage of rule number 1, rule number 2 wasn't as effective as we had hoped. There's that divergence high, none of the triggers through. That's where the reversal comes from. Weak triggers, that's where the reversal comes from. So these rules are designed to keep you on the good side of things. These rules are designed to keep you from taking chances, but rather embracing advantages. And there will be times when your path isn't clear because areas seem to be stacked. And this is 90% of your day. It's okay to do nothing. I can't stress that enough. It's okay to do nothing. It's okay to sit on your hands. It's okay to not be in a trade. Guys, the futures markets trades billions. Billions is exchanged every day. You don't have to be in every move. You don't have to be the first one in. You don't have to be the last one out. The easiest money that you'll ever make is going to come from in between these areas with momentum. I took this picture the day before Thanksgiving. 36 instances where those key Fibonacci areas stopped the market. 36 instances over an 11-hour period where the market stopped and would have produced a loser. Only 6 where the area actually broke. It's not the one time it breaks, guys. It's the 10 times that it doesn't. And that's how these rules come to be. These rules were created because more often than not, trading into an area is going to result in a loser, which means that there's no advantage in trading into an area. So, are you guys with me so far? Strong triggers on the large chart lead the way, providing the advantage of momentum, letting me know that that market is likely to continue in the direction of the trend. Once I have that momentum, I have to make sure I'm not trading into an area that could reverse the market or create an untradeable bounce. We're going to call that a clear path. Guys, once these rules are in play, once these rules are true, I'm done with the large chart. 66% of my advantages are in play. It's time to go look for an entry. The entry is going to happen on the small chart, the 5-1 chart. The entry is so precise that you're going to use a limit order. You will actually wait for the market to come to you. And you're going to use that limit order to buy or sell that little pullback created by the small crowd, that fight from the small crowd. But you're going to do it at an area, at a fib, at a midband, or a yellow 1-to-1, because areas create bounces. The same way they do it in rule number 2, we're looking for them to create a bounce in rule number 3. But we want those areas to be inside a trigger. So if I have momentum, if I have a clear path and I go to that small chart and I look for my entry and I see this. 3 divergences in the same price range. Remember, divergence is a loss of momentum. 3 divergences in the same price range on any chart is a termination condition. But on your small chart, what it's doing is it's telling you that the large chart is losing steam. It's telling you that the large chart, even though you can't see that change, is losing its giddy up to the downside or to the upside. So 3 divergences in the same price range may terminate the trend. It becomes even more powerful with weak triggers, smalls inside of the large. That's that rule number 1 lesson. More powerful still if the third pivot is higher than the previous from a low or lower than the previous from a high. Ladies and gentlemen, 3 divergences in the same price range is the only time I won't look for an entry on the small chart if my large chart rules are met. And I think that's worth writing down because new users tend to let the small chart talk them into trades without advantages or talk them out of trades through perceived disadvantages. So the only time I won't take an entry on the small chart is 3 divergences. But if I don't have it, I'm going to use a limit order to buy or sell that pullback at an area inside of triggers. And we use triggers because they're a moving average, and I'm not a math guy. Someone told me that there's this thing called the regression to the mean. And correct me if I'm wrong, if you are a math guy. All it means is that price returns to these moving averages. So price may return to the large triggers. It does it on the large chart. You see it all day long. Look at that. It breaks away and pulls back, and it breaks away and pulls back, and it breaks away and pulls back. And look at that. With that momentum, that pull back to the large triggers is one of those tails. It does the same thing on the small chart. So your entry chart will have large triggers from the 5-1. These are smooth. The separation between the large and small will define momentum on the small chart, but you're also going to have your 13-2 large triggers on that small chart. And these trigger lines will define where the retracement is most likely to occur, where that pullback is most likely to go. So for you brand new users, my first hour is the best of the best. My first hour is designed to optimize your chances of success. My first hour is the greatest look you could ever have on an entry. And the greatest look you could ever have on an entry is having what we call favorable large triggers. Favorable large triggers are wide in the direction of the trend. They're overlapping one on top of the other like two snakes riding piggyback, because what happens is, since they define where the retracement is most likely to occur, when they're one on top of the other, that box is its absolute smallest. When they're split, that retracement zone grows. So this is your look for accuracy. And then when you put a fib, a midband, or a yellow 1-to-1 inside of that retracement zone, you've got the perfect storm to create a bounce and continue with the trend. So let's define an entry real quick. It starts with the large chart rules being met. I want you to insist on the large chart rules being met, because those are your advantages. When you have a market that is pushing up, that has odds favorable momentum, absolutely nothing in the way to create a bounce, it's difficult to stop. But the small chart's going to try. So this is what your small chart's going to look like. Strong triggers, a lot of up bars, and you're going to go, hey, look, there's those triggers. There's those areas. I need a reversal bar. That reversal bar is going to be the visual. Hey, look, the pullback's beginning. The small crowd is fighting. And once I get a reversal bar, I have to identify where the retracement is most likely to go. How far down are they likely to push? Well, somewhere from the top of the trigger lines to the bottom of the trigger lines. This is where the market is most likely to retrace. This is where the small crowd is most likely to be able to push their fight. And the tighter these triggers are one on top of the other, the smaller that retracement area becomes, and that will help with accuracy. So from the top of the triggers to the bottom of the triggers, that's a pretty big box. That is about $170 worth of range there. So we refine even further. Triggers define the retracement. Areas define where the market is most likely to bounce. So I'm going to look for areas inside of triggers. That's such a key word. Inside of that retracement zone. Fibs, midbands, or yellow 1-to-1s. Divergence, lows, and highs are not areas inside of triggers. Pink 1-to-1s are not areas inside of triggers. Fibs, midbands, and yellow 1-to-1s. So this box, from the highest point of support inside of triggers to the lowest point of support inside of triggers, this is where the market is most likely to bounce in the direction of the trend. I want you to think about throwing a tennis ball as hard as you can. And those areas inside of triggers are where that tennis ball is most likely to bounce and come back to you. So here's the scary part for new users. You're going to do a little bit of study. You're going to go back and check this out, and you are going to have the trust and the faith in this methodology with just a little bit of study that you're going to activate a limit order. You're going to right click on your chart and activate a limit order. And you're going to say, all right, small crowd, come get me. 2 ticks above the highest point of support. 2 ticks above the closest bounce point to price. Because the large chart is screaming with nothing in the way. We don't expect the small crowd to get a lot of work done. But if they can push down to your limit order, you're in a long position. You're in a long position with the advantage of a market that is likely to continue in the direction of the trend based on the momentum given to you on the large chart. You're in a long position with absolutely nothing between you and your targets because there are no termination conditions defined by your large chart. And you have the advantage of having entered the market precisely where the market is most likely to continue in the direction of the underlying trend because of rule number 3 on your small chart. Guys, this is your high probability trade entry. This is all we've talked about for the last 35 minutes, is being able to define that point right there. So let's go through a couple more pictures of it. This is kind of the whole process in one picture. The reversal bar begins the pullback. The reversal bar is not your entry. Once the reversal bar prints, you're going to identify your trigger lines, the large and the synthetic. Create a box if you need to. The trigger lines are not your entry. Then you're going to find your areas within, fibs, midbands, and yellow 1-to-1s. And it's rare that they're just all in one spot. So you're going to create what I call the window of opportunity. From the highest point of support to the lowest point of support, there it is in all caps, inside of favorable large triggers. The market may bounce off of a midband. It may bounce off of these 1-to-1s. Hell, it might blow through everything. But anything on the wrong side of those triggers, that's not a part of the equation. This is beyond the trigger lines, beyond the retracement zone, beyond the bounce zone. This is where the market shouldn't go. This is where your advantage is gone. Your job is to activate a limit order a couple ticks above that highest point of support and to simply trust the process. Large chart says down, large chart has momentum, the large chart path is clear, and you guys wait for the small crowd to go up. That's crazy. Reversal bar signals the beginning of the pullback. At the time of the reversal bar, identify your trigger lines. This is where the pullback is most likely to return. But then look for the areas within, fibs, midbands, or yellow 1-to-1s. There's one line inside of favorable large triggers here, guys, a midband. Your job is to activate a limit order 2 ticks below it and to taunt the small crowd. Come get me. I'm ready to be in a short position with all these advantages. If they do, you're in. If they don't, you're not. We don't chase trades. We're better than that. And guys, anything beyond the triggers, anything on the wrong side of the triggers is not where you want to be. That's where that advantage is gone. That's where your edge is missing. Because if price can push beyond the trigger lines, if price can push beyond the areas inside of triggers, I don't want to be in this trade anymore. I certainly don't want to enter on the bad side. And you're going to use that concept of defining where the market is most likely to continue to also define where the market should not go. And this is how we define our first stop. Your initial stop will be placed 4 to 5 ticks above those trigger lines for a short, 4 to 5 ticks below those trigger lines for a long. If the market pushes through the triggers, through the areas, and makes it 4 to 5 ticks above those trigger lines, you will be stopped out of your position. You will take a loser. It's the most amazing loser you could ever take because it's a loser from a pattern that has been proven to win 70 to 80% of the time, which means that math dictates you must lose this trade 20 to 30% of the time for that ratio to be true. So you're defining where the market should not go. And the cool thing is once you get a reversal bar in the direction of your trade, it redefines where the market shouldn't go. You can reduce your risk even further. But what you have to do is you've got to learn this look. Let's commit this look to memory. Starting on the large chart, I'm going to take a picture of this one. We're going to do a little vandalism this morning. So we're going to start on the large chart. Won't even look at the small chart yet. Large chart has strong trigger lines. Small's above the large, larger wide, space between. Rule number 1 is met. Can you guys give me a Y in the room? This is typically the easiest lesson you're ever going to get. Strong trigger lines. Once you have strong trigger lines, and it happens to be on this bar, we're going through this historically. Has price reached the divergence high? It has not. Triggers have cleared the previous area. So the market's trading up here at 97.05, and a lot of you are like, but Mark, there's like 8 ticks to get to that line. That's not nearly enough room. About to show you why that's more than enough room. So rules 1 and 2 are met on the large chart. Large chart says, yep, here we go. Let's define an entry. It begins with the reversal bar. This reversal bar is the top of that bar, top of that one bar on the large chart. The reversal bar signals the beginning of the fight. Once I get the reversal bar, the first thing I do is I look for those triggers. And I say somewhere from the top of those triggers to the bottom of the triggers is where the market is most likely to retrace, where these down bars are most likely to go. But I know that my entry comes from the areas inside of triggers, and I create that window of opportunity and I enter that market just above support. And by doing that, that 8 ticks of potential profit turns into 38 ticks. 80 turns into 380. Some of the common things that people will do is they'll say, well, Mark, I chose not to take the trade because of this termination condition on my small chart. Remember, the only termination condition on a small chart is 3 divergences in the same price range. This is pretty common. I used to do this all the time until I finally got the lesson that this is where termination conditions happen on the large chart. Some of you will say, well, Mark, the colors don't match. My small triggers turned red. And once again, I have to remind you that momentum is defined on that large chart. And if those small triggers don't turn red, you're less likely to get enough loss of momentum to pull you back to your great entry. I see people all the time jumping in at the reversal bar. All that does is give you an exorbitant amount of risk and not much room to your profit target. I see people get head faked. We see this every day in the room, where it looks like the market's going to go up without you. But remember, this is a tiny little chart, and you guys get in at the very top of that bar, like almost to the tick. Your risk is still huge, and your profits are reduced. And it's that entry at the best of the best. That's the one that gives you the least amount of risk, and that's the one that gives you the furthest room to your targets. So you've got to go through and study this pattern. And we'll just take a look. I'm going to circle this one with the potential to break. There's one of those tails, momentum, potential to break. And I'm going to go to a smaller, faster chart. And I'm going to find this tail. And I'm going to see what it looks like with the two charts together. There it is. And it's a pullback. And it went right to the midband, right to the second retracement zone, and that's where it continued up all the way to Fibonacci resistance. Guys, this is your pattern. This isn't something that I have to hand pick to make a point. This isn't something that I have to go, oh, let me go back and look over 75 days to find 5 examples to try and convince people that this works. If you circle the tail, potential to break, this market pulled right back to resistance, right inside of those triggers, and continued down with the advantages. Guys, this is your pattern. So you've got to study this pattern. You've got to recognize this pattern. You've got to take a million pictures of this pattern. And I'm going to give you everything you need to get there quicker right now. And I went through and I revamped these a little bit over the weekend. The goal is that you first look at your large chart and you identify momentum and path, guys. That's the goal. I want you just honed in on that. This is the core of your education, and understanding these two concepts opens the doors for more opportunities. So take 25 pictures of each and take the time to explain why the rules are met or why they are not. Do it for strong triggers, weak triggers, clear path, and termination. Post them in your spreadsheet. Post them in the room. Study them each day until you're confidently identifying your rules being met as well as not being met. That's this basic rules section, guys. If you get to work on taking those pictures, and even more importantly, once you take those pictures, annotate your chart. Create that correlation between what your brain sees and says. I have strong triggers. The smalls are above the large. All the triggers are up. The space lets me know they're strong. I have the advantage of momentum rule number 1 met. You can't take 25 pictures of these and take the time to annotate and not understand strong triggers. It just can't be done. And then eventually, you'll never trade with weak triggers unless you make the choice to trade with weak triggers, or unless you make the choice to trade into termination conditions. So that's the first thing I'm going to give you. You're going to get everything you need to be successful. The next thing I'm going to do is I'm going to give you the high probability trend trade checklist. So for you guys that have been stealing these for the last couple weeks, I updated this one. All this is it's a checklist to get into the market. If you're using Market Replay, it's a checklist to go back to when you pause before entry. Is the market coming from a strong top or bottom? It's not mandatory. You can take a trade without, but a strong top or bottom is the precursor for the highest probability trend trades you can take. So this defines it. A strong top or bottom is a no triggers through termination that reverses the market. Termination, now it's a strong top. Termination, now it's a strong bottom. In order to consider an area a strong top or bottom, the triggers, both lines of the small, must not break above. So if one line gets above, it can still be a strong top. Odds favorable momentum on both charts. This is the best of the best. Guys, will you give the other Gary a Y? If you can hear me in the room, please. It's something about Mondays, guys. I don't know what it is. Something about Mondays. You come in and Discord just wants to keep you out in the cold. So odds favorable, large trigger momentum, guys. Smalls above the large, space between. Momentum is always this look. So when you go back and take those pictures, make sure this is what they look like. Weakness is always this look on every chart. And I want you to use the word weakness. I want you to use the phrase, anything can happen. Updated the termination condition. First, it's a termination, always a termination. Wait for the reaction. This is nothing more than the potential. And there's your clear path. Those are the three options. And then defining your entry. The second page is, whoops, let's put that on the second page. There we go. Is just something to print out. Put it on your desktop, laminate it, use a dry erase marker. Going through that, is the market coming from a strong top or bottom? Do I have momentum, a clear path? Have I defined my entry area? And I'm going to tell you guys right now, nobody in the history of this checklist has been able to answer yes truthfully to all four and done worse than 70%. Don't take my word for it. Learn these rules, go study it. Triple dog dare you to prove me wrong. So you're going to get that as well. And now I'm going to give you the KISS plan. In the KISS plan, this has been updated as well. So if you guys, I'm going to put all this in the room. The KISS plan is a stepping stone in your learning journey. And I love that phrase. The KISS plan is a stepping stone in your learning journey, guys. This is not your first or your only trade. This is your first trade. We're laying a foundation. This is the trade that's going to teach you to recognize the other trades. This plan is designed to optimize your chances of success with the high probability trend trade. That's an important phrase. This is the absolutely, positively best of the best, holy crap, I can't wait to take this trade version of taking the high probability trend trade. Through study, simulation, class feedback, continuous practice, you're probably going to modify this plan. You'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. So there's two things every trader needs to know, and this is what a plan does for you. Why will you enter the trade? You've got to define it. We've done that over the last hour. Rules are simply a description of a pattern that has been proven to win more than it loses, which means you've got to go do that study and prove to yourself that it wins more than it loses. If you verify and trust this pattern, there's no reason to not consistently enter when your rules are true. Your rules will help remove the emotions of trading. And then you have to know why you will exit. And exits are taken either at profit targets or when the advantages that had you enter the trade have gone away prior to targets being reached. So your KISS plan first defines entry. This is what we've talked about for the last hour. And then you've got to manage. And guys, management, ask anybody that's relatively new to trading. Entries are easy. I can enter the market all willy-nilly all day long. Watch this. That was so easy to enter the market. I don't even know if it was a real trade. All I had to do was smash a button and I'm in. That's how easy it is to get in the market. But you've got to manage it. You've got to do something with that one. And the KISS plan management's designed to help you understand and trust stop placement, as well as being focused on getting profits captured quickly. You will craft a plan tailored to your personal goals based on your experience reading the indicators. So guys, the KISS management plan is 100% dependent on your ability to enter the market where the market is most likely to continue. It's nothing but an if-then scenario, start to finish. So if entry is 2 ticks below resistance inside of triggers, there's my 71.34 entry, then my initial stop is 4 to 5 ticks beyond the triggers, 71.49 stop. And guys, that is 15 ticks, $150 worth of risk per contract. But this is where the market should not go. You're going to know your risk before the trade is ever entered, guys. And your targets are going to be predefined at 100 and 200. Remember, we're learning how to get paid. This is the first step. One of two things are going to happen. You're either going to get stopped out. That's a normal part of a positive equity curve. Or you're going to get a reversal bar in the direction of the trade. You guys like these new pictures? If a reversal bar prints in the direction of your trade, you will redefine where the market should not go. Your new stop is 2 ticks above that reversal bar. You now have $30 of risk per contract in this trade. It doesn't mean that you're guaranteed a winner, but what it means is that if things go south, if the small crowd fights again, you're going to lose $30 per contract based on that amazing entry and confirmation that the market is going the direction of your trade. Targets don't change. They're still at 100 and 200. So you're either going to get stopped out for a small loss, but if you don't, if your first target is reached, you just made $100, guys. If price reaches your first target, one contract is automatically removed. It pulls it from the equation, and those funds go into your account. You're learning how to get paid. And with one contract remaining, you will move your stop to break even. You will take all of the risk off of this trade after you get paid. And that helps develop the trust to learn how to hold for those bigger moves, because the large chart said down with strength and nothing in the way. If price reaches your second target, you'll be removed from the position with $300 and your trade is over. And guys, that is a $300 winner. One trade, about 4 minutes of your life. $300 a day is a $75,000 year. That's the goal. The goal is to reach your daily profits consistently. That's what reaches the long-term goal. And as you grow, learn, and understand more, the potential for higher rewards becomes evident. My goal, if you're brand new, I want you to see the potential to catch $200 a contract. You'll see it within the first week. That's a 6-figure income based on your trading if you're consistent. So I promised everybody in this room, I will give you everything that you need to be successful with the software right out of the gates day one. So we learned the trigger line and the Fibonacci rules for when it's okay to trade. We broke them down individually. You know exactly what they look like. You know exactly how to study them. You have a place to put all of your study pictures, and you can get feedback on every picture that you've taken. You have a plan that you can practice. Your plan is developed to teach you to not only understand where the market shouldn't go, but to put you into the market where it's most likely to continue. You have the ability to receive feedback on everything that you see and do, 15 hours live every week. The only thing that you are void of right now is the experience to be comfortable with this plan. Experience comes through repetition. So that's where the second half of class really comes in. Every time you take a trade, post it in my room. Win, lose, or draw, because you need to know what you're doing right and wrong. So tell me what you see. And guys, this is one of the most ignored parts of people posting in this room. I'm just going to mark my winners. I'm not going to talk about why they won, but man, won't he be proud. Can't stress enough, I don't care about the money you make on simulator. Doesn't matter to me. My goal is that you're reading your indicators properly because I want you to have longevity in this business. I don't want you getting lucky, short-term victories, creating long-term failures. I want you to be able to say to yourself, I have these advantages, let me find an entry. So our second hour is going to revolve 100% around advantages. Every chart posted is going to go back to momentum, path, and entry. Right now in the room, I'm dropping in my spreadsheet one more time. Remember that my spreadsheet gives you a huge head start on your chart reading 101. It's a place for you to trade track. It is 375 pictures of Nexgen users and what they've done with the software, management, high probability trade entries, patterns, and a place for you to build your plan. Inside of the zip file, you're going to get chart reading 101, the KISS plan, high probability trend trade checklist. You're also getting this right here, new users. Grab hold of this and read it. This is everything that we've talked about in the last hour, consolidated into 2 pages. Inside of that zip file is also the PowerPoint that I used to teach each and every day. So that's my first hour. Are there any questions? And let me remind you that I have been exactly where you are. I have been on day 1, and I have drank from the fire hose, just like we did this morning. Whoa, what did that do? And that's very much what it's like. Gosh. I was just looking for the picture of it. There we go. Guys, this is us. Day 1, day 2, day 3, taking all that information and saying, man, that's a lot. How do I get paid? How do I get paid? How do I get paid? Guys, you get paid via the process. You get paid from the study you do. You get paid from trading a pattern that wins more than it loses. So I share this before I come back from my break. The key to everything that we do, is having a foundation. We just built that foundation. The very basics, and then each week compound a little bit. Get a little bit better every day. Stop trying to get to the finish line before you even lace up your shoes, guys. So for you new users, I blanket with very conservative rules, recognition of advantages, and a solid plan that optimizes chances of success as you learn to read your indicators. So for new users, you're going to feel like all termination conditions are bad, and no momentum is bad, and no areas inside of triggers are bad. Blanket rules, because it increases the likelihood of success, and confidence comes from the memory of success. They're not always bad, but until you have the experience to know when to use exceptions, it's safer that way. You ever heard learn your rules like a scholar so you can break them like an artist? That's what I'm doing. We're creating this foundation, and man, I get giddy when I see what you guys pull off with this software from your ability to read charts. Just like anything, the more time you spend with it, the more you're going to see. So learn the process that yields the results. Learn the process that yields the results, and the results seem to follow. That's where the KISS plan comes in. If you keep it that basic, if you follow simple rules, and you're okay not looking for all the trades, only the best trades, you can find an extraordinary level of success. And I say this going into the second hour because new users, you will see more experienced users taking trades that are not high probability trend trades. They're a result of their ability to read their indicators. So don't police them, but rather understand this is where you're headed with a little bit of study, simulation, and class feedback. Question everything. If you don't understand, question. If it doesn't make sense, question. If you don't think I'm right describing what I'm describing, raise your hand. Say, hey, Mark, I thought that was this. Force me to clarify. I don't mind. Doesn't bug me. I want you to learn. But give yourself a little grace, guys. You're brand new, and it's okay to be. So, with that being said, let's look at the live market real quick. My large triggers are green and my small triggers are red. Do I have strong triggers? What do you guys think? Who has a guess? Well, they just went red, right? No, because they're not wide. Perfect. We're just in a holding pattern. Well, now we've got it. That's how quickly the market can change. So I have momentum. Do I have a clear path? Price reached Fibonacci support and all my triggers are above it. No. Guys, I'm missing 66% of the things that make my trades amazing. I don't even need to look at a smaller, faster chart. S&P. Smalls are inside of the large. Everything is green, but smalls are inside. Do I have the advantage of momentum? What do you guys think? I agree. Price reached the divergence line. The small triggers are through, but the large triggers have not broken through. Do I have a clear path? No. Guys, that's how easy it can be. No reason to go to the smaller, faster chart when the large chart says no. And I know that seems oversimplified, right? But in two markets, in under 2 minutes, we have defined that our chances of success are better from doing nothing than they are from turning our attention to a smaller, faster chart without advantages. That is exactly what successful traders do. So I'm going to take 5 minutes. I'm going to walk away. I'm going to stretch my legs. When I come back, we're going to look at the pictures that you guys have posted. I realize, like Paul said, there's a little Super Bowl hangover going on. So we'll go do a little historical. We'll look for some stuff back here, see if there's any opportunities. I'll try and come up with some great lessons, but please ask a million questions. I'll see you guys in 5 minutes. Go stretch your leg, or heck, stretch both legs. It doesn't have to be just one. Back in a minute, guys. Second hour, or second half, however you want to say it. I'm going to scroll up to the very top of my chat box. We're going to start looking at some things, and I'm just going to tell you guys right now, I'm going to turn these into as many lessons as I can turn them into. So we're going to start. Steve Diego posted last week right at the end. Philly was destroyed once again. I don't get that. Destroy your town because they won. Did not clear trouble. Top of bar at 60.71, 75 fib. It was moving so fast I was a second early. So guys, this is a look that's traded in the room quite a bit. And it requires the back of a bar. Yeah, pretty much, Morgan. It requires price to get away from a fib, to get away from the decision-making zone. This is a trade that Steve takes. It's not a high probability trend trade. The entry was perfect. And it's really using the idea of momentum and path to capitalize, to make a little bit of money really fast and do it repeatedly throughout the day rather than trying to make it all at once. It's the idea that base hits pay dividends, and once you understand momentum and path, you can begin to capture these. It's an awesome trade. And then here's the same thing going the other direction. Once everything gets clear and the path is there, find an opportunity to get paid, to take quick profits on a smaller, faster chart using nothing but momentum and path. And Steve, you did it awesome. You did it great. And now, Steve, are you with us? Because this is a lesson. This is a lesson that we have to talk about. Mid-band term because the large triggers were a full bar away. And you said, i.e. the gap trade. No such thing as a gap trade. It's a gap theory. And what the gap theory says, Steve, is that when price accelerates away from those large triggers, it's likely to snap back and close the gap to those large triggers. And if you guys go to the client trade section in your spreadsheet that I gave you, you're going to see those pictures a lot. And what it means is that when price reaches a Fibonacci area, when it hits a mid-band, when it hits a fib, and the large triggers remain a full bar away, price is more likely to close the gap to those triggers than it is to continue down. So it keeps you from trying a short trade too early. And some people try to capitalize on going back to the large triggers. Steve, what you did is you reversed it. Price was likely to close the gap back to the synthetics, but you somehow went long from the synthetics back up to the mid-band. You went the opposite direction. You traded directly into a termination condition. You traded into a termination condition where things were rolling against you. Does that make sense? You reversed the gap theory. No, it's okay. So if you were going to try to use the gap theory, it would have been this push down, not that push up. They worked, which is cool. Price did return to the large triggers. And then can we just turn this into a different little look? And this may have been what was on your mind, but because you mentioned gap, I had to point that out. In 2004, Nexgen started teaching an idea that when a termination condition holds and the small triggers roll, there's an opportunity to sell a pullback at them. So your exit was actually the entry for that particular trade. And you just kind of did a little suck back to it. I think you might have pulled one off here. But I wanted to get that lesson. That the gap theory says price returns to the large triggers, not back to the mid-band. Good stuff, man. I hope that makes sense. Sneaky. All right, let's go through and see who's next. Dun, dun, dun. Andy Man on Market Replay. All right. So this is what today's going to be. Andy says, check it out. I'm coming from a pivot stop out with divergence. Right? Andy, you're defining your bottom there. Am I right with that? Are you in here? So now we get another awesome lesson. And let's talk about pivot stop outs, guys. Because you're going to hear that in the room. And you know I've got something written. So I'll drop this in the room as well. But I want to go through the whole process of identifying a pivot stop out. And it starts with a pivot. And a pivot is nothing more than where the market changes direction. And then if the momentum of the market doesn't follow the pivot, that's when we see those divergences, the divergence highs, the divergence lows. So this is just a pivot with a loss of momentum. This is just a pivot. So far, so good, everybody. Pivot, pivot, pivot with a loss of momentum. That creates divergence. Pivot with a loss of momentum. That creates divergence. On its own, it's not a strong top or bottom. It's not a pivot stop out. It's not even a termination condition. It's just a pivot with a loss of momentum. This is where pivots with a loss of momentum become pivot stop outs. So first you have to have a pivot, prints a pink line. And then when the market returns to that divergence high, exceeds it by a few ticks, and then heads the other direction, that's when we get what we call a pivot stop out. And a pivot stop out is a very strong termination condition. And all it means is that the buyers were going up and the sellers took over. And when the buyers tried to break through that line in the sand created by the divergence high, the sellers let them get about 5 steps past it and then unleashed. And these pivot stop outs are very powerful. And they're even more powerful when they happen at Fibonacci. So once again, this is just a loss of momentum at a pivot, and it's that retesting, that exceeding and failing of the pivot that creates a pivot stop out. Pretty good lesson. I dropped that one in the room. So Andy, when I look at yours, here's a pivot. They never took it out. So all this is a divergence in the middle of nowhere. Does that make sense? Kind of a cool lesson, I think. And this is just being able to name it. That's okay. And then let's go through it. So one of the things that happens, you're welcome, is guys, you're all amazing annotators. And Andy, almost every picture I get from you brags about momentum and brags about your clear path until you break rules. And then you very conveniently leave these things out. So you had momentum. There's no doubt about it. And the market is trading directly into a divergence high. It's trading directly into a fib. And it's trading directly into 3 divergences in the same price range. Do you see it? You've got so many reasons to not go long there. And you did anyway. And it worked out. And you made money. And I love that. I love that you made money. But guys, one of the things your annotation does for you is it's reaffirming rules. It's reminding you why you're trading. Or even more importantly, letting you know what you're up against. So I'm not saying this is the wrong trade, but what I'm saying, Andy, is that when you took this trade, I hope you said 61.2750 can absolutely kill my forward progress. This fib, this divergence, all of this is where things can go south in this trade if they're going to go south. And I think that you knew it because that's exactly where you took profits, right at trouble. And then probably got break even and said, if it goes back down, I won't give anything up. And if it goes up, let's go to the next area. Does that make sense? So you traded directly into the termination, but you got paid at trouble. You had the advantage of momentum. And guys, one of the biggest reasons I want you always talking to yourself, what am I looking at? Do I have momentum? Do I have a clear path? Do I have an entry area? And Andy, you may not need this lesson, but this is for everybody. Is that as soon as I say, well, my momentum isn't the best, I know that I have to change my management strategy because it's no longer high probability. So Andy was void of a clear path, which means that he knew going into this isn't perfect. I need to manage assertively. And that's one of the reasons why we talk about advantages and we talk about defining the advantages and looking for the advantages and really speaking out loud about the advantages. It's not that I'm telling you don't take the trade. Do whatever you want to do, guys. But what happens is when I say out loud, I don't have a clear path, I know that I have to manage assertively at trouble. So your ability to identify advantages is going to play a huge role in your management. And Andy did it perfect. Because it's not a clear path, I'm going to take contracts off at trouble, get to break even, and if the market continues up, I'll look for the next fib. And if it doesn't, I'm not willing to give it away trading into that. So Andy, it's a great trade. It's a good look. I like it. Did I just put that on yours? I did. Sorry, I didn't mean to put a laughing emoji on there. Whoops, man, I did it again. Butterfingers. So great lesson. And guys, I'll do this with your charts a lot of the times. I'll take a chart and I'll turn it into a lesson. Even if you don't need that lesson, someone in the classroom probably needs to hear it. So Andy, great job, dude. All right, Miss Jen. When I entered not odds favorable momentum, definitely a clear path, absolutely coming from a termination, everything's going up. I mean, this is beautiful. Great large chart look. What's the only challenge? Jen says, I entered a few ticks above the mid-band. Right? I entered a few ticks above the mid-band. On the wrong side of the triggers. So I don't have momentum. My path is clear. I don't have an area inside of favorable large triggers. Let me see what that looks like on this. I don't have momentum. I don't have an entry area. Let me just take a clear path and hope for the best, right? And Jen, it works out beautifully. You get in, and it goes up, and you get paid. So let me show you guys one of the things that was rattling around in Jen's head that she didn't write on the chart. And this goes back to language. Let me use my call out here. Do you guys remember this recipe? Price reaches an area. Where are my triggers? Jen knows that recipe. She's done a lot of study. Price retraces to Fibonacci support. Every one of her triggers is up and away from the area. This is an area likely to stop the market. Small triggers are up, large triggers are up, path is clear, area is likely to stop the market. Large are up, synthetic are up, smalls are above the large. This is the area likely to stop the market. Guys, these are all advantages. Jen probably said, you know what, with this much going up and a fib likely to stop the market, that's worth $100 to me. I got fibs, I got mid bands, I have every indicator up. I'll take this trade. It doesn't fit the rules 100%, but I'm counting more advantages than disadvantages. Does that sound fair, Jen? That's what chart reading does for you. Chart reading sets you up to take the next trade, to do it logically, to understand when there's challenges. I think you did this one beautifully. And you also set the loss. You decided what you were willing to risk. And I'm guessing you were probably 3 or 4 ticks below the fib, right? Maybe $70 worth of loss. Yeah. All day long. Beautiful. And then one of the things Jen could have done if she said, you know what, momentum's not perfect. I like it. It's a good look. Everything's likely to go up. She can wait for that reversal bar and establish her risk 2 ticks below it. Whatever works. But I love it. I think it's a great trade. It's an awesome chart read. And that's really all it is, right? Is taking those chart reads and translating them into trades. Steve Diego, 50-50 trade. Sat down a minute late, just missed the Nexgen momentum setup. Got in, got out. It's just a momentum trade with quick profits. I mean, talk about getting something out of nothing, Steve. Everything says down with momentum, but the path isn't clear. And Steve, you pull a rock star $200 trade. Nicely done. And then go in the other direction. Everything says up. You take the trend trade from the right side of the triggers. Didn't want to fight the triggers. And it's pretty easy money. Nicely done, Steve. That first trade is just, man, that was, you said it was slow. That'd be hard to watch so slow, but you did it perfect. You had the rules met 100%. All right, Bob, be the man. Odds favorable. Clear path. Practicing with market replay. Strong bottom, I love it. There was your first momentum. So you just jumped in. So one thing, Bob, and I just want you to see this, and I'm not knocking you. You got in at 98.50. So you got in up here with that strong trend and clear path. And I love it. I think you did it perfect. Just want to make sure you understand that this odds favorable momentum down here has nothing to do with that trade up here. But you did it beautifully here. You had weakness and it retraced pretty far. And then when everything rolled and the momentum was strong, you just capitalized right up to the fib. Dude, that's an awesome trade. Nicely done, Bob. You have been paying attention. This was a loser. So you did have odds favorable. You didn't have a clear path. If you had entered at the area inside of triggers, it was easy money. But since you didn't, risk was tough. And you held way too long. So I want to talk about a really common pattern. When you only have the potential to break, and I'm just going to do this right here. When your trade is 50-50, only potential to break. Divergence on the small chart is probably the biggest killer of the trade. So you can put this one into, put it in your spreadsheet, guys. When I have a 50-50 trade, that divergence is more likely to kill the trade than not. And it becomes an exit condition. And if you go to the KISS plan that I gave you guys in the room, when you look at that 50-50 trade, it says no divergence on the 5-1. It reminds you no divergence to trade. And it tells you again in management if divergence prints, exit the trade. So this is where repetition is going to help out a lot, Bob. Knowing exactly what you're up against lets you know how to manage it. And that one, because of your late entry, you chased the trade, right? You didn't have anything to put your stop behind. Sometimes if you can't get the best one, it's just better not to have it. That's one of the reasons why the methodology is so effective, is it minimizes risk. I like the idea behind it. That divergence though, this right here was your, hey, let's get out, and it would have had you out maybe a tick or two instead of 180. Yeah, sometimes we just have to sit on our hands. Professional waiters, it's what we do. Great stuff though. All right. One heartburn, one 50-50. So first trade is pull back to support inside of favorable large triggers. Easy money. Second trade was a short off of the outer band, white bar. And this is a pattern. I love it. Heartburn entry on the outer band on the way down. This is a pattern that Wayne recognized. A lot of professional waiting today. Yeah. This is a pattern that Wayne started to recognize when he incorporated his market flow chart. He's like, man, he goes, I'm just going to start looking for patterns, and he's good at it. And you are, Wayne, you're good at it. And this was one of the patterns that he recognized, and it created opportunity for him. And it fights everything, and that's why he calls it the heartburn trade, because he can hear the hair falling out of my head every time I see it. Everything says up, and he says when the market gets overextended coming back in, I can usually grab $100. And you actually could have done it right there as well, and maybe even right there as well. And it's not a high probability trend trade. Hell, it fights everything. But it's a pattern that he has proven wins more than it loses, and that's all a trading plan is. So this is the stuff, and I sent him a message saying so. This is the stuff that I get excited about. When you guys learn how to read your indicators, you're going to begin to see opportunity. And Wayne, you really have done an outstanding job of finding opportunity where new users have to say absolutely no trades. New users have to say, I can't fight all that. Experienced users can say, hey, look what I see. And it's also coming off the pivot stop out. You also have the perfect termination condition here. Finding a way to capitalize. Rock star, dude. All right, Boaz. So Boaz, you said momentum, yes. Clear path, yes. Good top after the cross on the fib down. I'm going to respectfully disagree. It does. It helps, Wayne. Thank you for the annotation. And I do appreciate it. So we're just going to turn it into a couple lessons. So good top, it's not a good top because it's actually not coming from a termination condition. And Boaz, remember that a good top isn't mandatory. So when I tell you guys you're not coming from a good top, please don't take it as a negative. It's not. It is not a negative. It's just when it is there, it's like one extra positive. You said momentum. I agree. Small's below the large, larger wide, and there's still space there. I love it. That's a great look. Rule number 1 is met. And then when we get to rule number 2, are you saying it should go from fib to fib? There is never a should in day trading. No, there is never a should in day trading. But you know what? One of the most, it could. I like that. I think language is important. So right here, price reaches triggers above. Do you recognize, with a little bit of leading the witness, that that's actually a termination condition? You actually traded into an area that may stop the market, that divergence low. Price reached it, all the triggers were above. Does that make sense? Cool. So what does that say? All it says is, you know, my path isn't clear. I may need to manage assertively. So I want you to see some of the greatness of this trade. Pull back directly to resistance inside of triggers. Great entries create manageable trades. And then this divergence low at 69.50, right there, there's your trouble. There's your trouble spot. There's your first profit. And then once you get a second divergence, you say, whoa, my clear path is really slowing down. Let me exit that position, and you don't get caught in this. Does that make sense? I like it. You had momentum. It wasn't a clear path. You had the perfect low risk entry. And then your large chart defined exactly where you need to manage a little more assertively. Great stuff. And thank you for the annotations. Nice stuff. Termination, odds favorable, potential to break. You go short off the outer band with the potential to break. And it works. Didn't wait for anything. You didn't even wait for a down bar. You just jumped in. I'm glad it worked for you. That's a lot of faith in a little white squiggly line. That's definitely the heartburn trade. Nicely done. Wayne, you're consistent, man. You're consistent. That's all you could ever hope for. And you said this is about 70% for you, huh? 70 or 80%? Good for $100? Easy peasy? It's awesome. That's awesome. Can I show the other side of what that does when you start to recognize things like this? And this is for everybody. This is how my brain works. Whoops. So this pattern is typically good for $100 against everything. Wayne knows that, right? And that's his trade. Boom, boom, $100. And I'm going to do this. Because that pattern is good for 100, 70% of the time, if I'm looking for a trend trade long, I won't enter until that 100 is satisfied. This is kind of how you start taking your patterns next level. I know that this typically pushes down $100. I'm not going to try and enter long against that. I'm going to wait for at least the $100, and it happens to be right at support inside of triggers. You know, but it keeps Wayne from saying, oh, I'm going to try that jump in trade because he knows he's at the outer band. I'm going to try and catch this off of the triggers because he knows that that pattern's usually $100. And that's kind of the snowball effect or the butterfly effect that comes from recognizing patterns, is you might not even realize that you're going to work it into a plan. That's exactly how you found it, waiting for the trend trade, looking for the pattern that leads into it. Pretty crazy, right? That's what chart trading does, or chart reading does. Never go long into the outer band. And for me, I don't try to go short until I'm back inside of it if I see it. I don't actually have it in my current trading plan, but back when it was a part of one of my plans, I would go long off the top of it and absolutely no shorts until it came back inside, and that's just kind of one of the patterns that I recognized. Good stuff. Man, what a grindy market. What do we think about this? Price reaches Fibonacci support. All the triggers are up and above. Support was likely to hold down here, wasn't it? Some of you might have tried to take an opportunity from there. That was it. Same spot. Weak top all the way back to the mid band, and now we're starting to get momentum, but we're directly into that line in the sand created by the sellers when they stole momentum. So 2 live charts, no trade setups. I'm gonna open up another one. Even the NASDAQ. All right, Josh. Here, I'll open the NASDAQ too. We'll see if we can get any lessons on it, because we can typically go back to the NASDAQ and find things. Had to reboot. Yep, same thing every time, Gary. Gotta reboot. I don't know why it does that, but it does. So weak top, odds favorable, clear path. So why was the mid-band a termination condition, Josh? Your large triggers were not a full bar away. Weird, Gary. Because of the weak top. That's what I wanted to hear. So when price doesn't reverse from a key area, the mid-band is more likely to hold. And Josh knows that. Patterns. So Josh said, I'm not going to go short into that mid-band from a weak top. I just choose not to. I like it. Great job. And that's one of those things where understanding where the market is coming from can pay dividends. A lot of big moves without areas inside of triggers. Not many pullbacks, but the ones that pull back too far on the NASDAQ today. There's ways to avoid that on the NASDAQ. Oh, I'm still calculating. Hopefully I don't crash it. Guys, NASDAQ's about 10 times faster than any other market. You can see it. I mean, that's 30 minutes worth of NASDAQ. Right there. There we go. Odds favorable momentum. Pull back to the mid band inside of triggers. I mean, from the lowest point of the triggers to the highest point of the triggers. From the lowest point of resistance to the highest point of resistance. The only thing on the NASDAQ is that when those small triggers right here are above that reversal bar marker, for me, that says pump the brakes. If you're going to enter on this short trade, enter with a close on the correct side of the small triggers. It's a 21 EMA, Bob. It's only for the NASDAQ, Josh. The NASDAQ's a different animal. This is a 13.2. Your small chart is a 13.2. If I go to crude, the large chart's a 13.2. S&P, the large chart's a 13.2. NASDAQ, my entry chart is a 13.2. My large chart is a 34. These small triggers are crazy. crazy strong. I don't ever want to fight them. So on the NASDAQ, let me cancel this out. I want you to see this. For you NASDAQ traders, the small triggers were above the reversal bar marker. Does everybody see how the small triggers behaved as support right there? This is the greatest lesson that you'll ever get if you're a NASDAQ trend trader. So if I'm going to take this trade, I want to take it from below those small triggers. I want to force the market because look, it's bouncing again off of them. And if I never get that close on the correct side, I never take this trade. It doesn't guarantee a winner, but at least then I can establish my risk behind it. We'll let this play out. We'll see what happens. Areas inside of triggers. Once my rules aren't met anymore, Kurt, I don't take it. There we go. Now we get to the right side. We can identify our first trouble spot. Our risk is already established, right? A second higher divergence might be an exit rule. But do you see how that works? It acted as support. And now the small triggers are rolling down. The synthetics are down. The large are down. Doesn't guarantee a winner, but at least gives me a fighting chance. Yeah, my rules still have to be met, Kurt. That's the biggest thing. Should we see if they make it to the fib? Boaz said they love to go from fib to fib, right? So let's see if they do it. Notice the small chart fluctuation right to the small triggers, and that's exactly where they tried to push down again. There's little patterns on the NASDAQ. They're just a little bit different. Second higher divergence is a bad sign. Probably going to take out that previous pivot. There you go. That's a NASDAQ pattern. Could you take a re-entry with another close below? Two divergences on a high probability trend trade doesn't kill it. Oh, you're right into a fib, aren't you? Yeah, see, I don't have that fib there. Jen, it's probably on my end, to be honest with you. I don't open this chart a whole lot. Here, let me reload my historical data and see if it changes it. But for you NASDAQ traders, that was an opportunity to get in on the correct side of triggers and then the second higher divergence. Oh, Dima, I'm sorry. I saw the pink and I didn't notice. I just automatically went to you. You're my default. Sorry, Dima. So, Dima, every morning, do you go to Documents, NinjaTrader 8, Database? Do you clear the cache and tick? Do you clear your temp folder? Okay. Hold on. 10:53. So we're in the same time zone. Right on. And I know that you know all this stuff. And check it out, guys. It pushed up higher. There was your close on the correct side. Down it goes. So Dima, sometimes, and that was the 10 o'clock update. No, maybe. Sometimes we're just off. I'm still reloading right now. I change my stuff a lot. I rebuild a lot. 3 divergences in the same price range. My brother and I do this a lot. We'll look and he goes, dude, I have a fib and I don't have a fib. And either way, 3 divergences keeps us out. One thing that we can do, and I always say trade your own charts, but I'll go to database management if I really think I'm wrong, and I'll reset and repair and see if that helps. But I always tell you guys, trade your charts. Mine may be different. Let me make sure. Yeah, you are NASDAQ, March 25th. I can also rerun my Ninja script and see if that changes it. I don't want you guys to think you're the broken one. A lot of times it's me. I'm rerunning Ninja script right now just to see what happens with it. Sometimes in the room you'll have people go, I'm short, and someone else is like, I have a fib. And it's like, you don't get to pick who's right. Yeah, see, mine's still... You've got a couple more fibs than I do. Is your update... Because that one started printing, Dima, is your update period 120? I think I am, Steve. My wife is. There's no problems with it now. I look at that too. Because if we have different update periods, sometimes it'll throw different fibs in there. 120, yeah. I've run out of everything that I can come up with, Dima. Sorry. There's one other thing. New chart, NASDAQ, 34.5. I'm going to build a brand new 34.5 and see if it comes out different too. And then Kurt, we'll look at yours while I do that. Then we'll just take a little break, guys. Man, Kurt's mad at me. Solid bottom, no triggers broke. I love it. Odds favorable momentum, potential to break. Entered after close above small triggers. So, Kurt, misunderstanding of the lesson here. Let's take a picture of your picture and talk about why. And this is a NASDAQ thing, 100%. If I reach my area inside of triggers, that's okay. If the small triggers are more than a bar away, Kurt, I'm in at the area. It gives me risk. Or it establishes my risk and it gives me time to get back to those triggers. Getting in up here is just jumping in. At that point, and think about it, this is your area, this is your entry. Oh my gosh, that's so far away. And then once again, you get out right at the area inside of triggers with the small triggers a bar away. So you exited right at the right entry. It takes some time to get it right on the NASDAQ, Kurt. It really does. But that is one of the best lessons with the NASDAQ. Because it's going to, it's virtually no risk on the trade when you get back to those triggers. And if it doesn't bounce, perfect. Get paid. And then that was your pullback right to the area too. That was just another trend trade. Look how your triggers told the story. Good stuff. Oh, I thought I built a chart. I must have closed it out. Nope, there it is. And then Dima, I built another one, and it is the same. All right, guys, I'm going to go take 5 minutes, stretch my legs. When I come back, the classroom is yours. When I come back, the classroom belongs to you. So I want you guys use guys, tell me what we're going to talk about. Tell me what you want to discuss. I'm going to go stretch my legs for a minute. I will see you in about 5 minutes. I muted the